Stephen Wieting is Managing Director of Economics and Market Analysis at Citi. He joins us now from New York with a preview of the third quarter. Mr. Wieting, welcome to Bloomberg News.
Thank you.
What are your predictions for the third quarter?
Well, we do think that the earnings level for the third quarter will be above consensus estimates, which is usually the case. I feel confident that they will beat those estimates, but I would also tell you that I think investors already believe that as well, that we are not going to raise expectations so markedly as was the case in the second quarter, where you really turn people's views on the end outlook for the economy.
Right. Well, you have in the past, in your appearances here on Bloomberg TV and on Bloomberg Radio, used the term self-reinforcing confidence. What's it going to take to get that back into the markets?
Well, I think there's been a reasonable amount of it. I mean, the stock market wouldn't have recovered as rapidly and as significantly as it had if the outlook for the coming year would be for another year of decline in earnings. And certainly the credit markets have actually outperformed equities in many respects. We're at pre-Lehman levels for, let's say, BBB corporate borrowers at spread levels to treasuries that are actually below. So, I wouldn't call everything easy skating, but there has been a great deal of confidence restored in financial markets, as you can see from the pricing.
Are monthly inventory declines still giving you a cause for concern, and how's that affecting production?
Oh, I think that those are giving me cause to expect the upturn to last and endure. The caution on the part of producers, the fact that we've had a relatively minimal rebound in production away from the vehicles market, away from autos, where the rebound's already been quite meaningful. It's in fact leading us to believe that we have a pretty long period of manufacturing recovery ahead of us, but perhaps not as quickly as the speed of the last few months.
Are non-financial profit margins continuing to show improvement in your estimation?
I think so, and I think that you'll see that in the third quarter. Year-to-year measurements of sales and earnings are both down. The economy is smaller than it was in the third quarter a year ago, so you can attribute that to cost cutting, and you'll hear that constantly. But I think margins themselves are improving. I'd say that the quick, rapid snapback that we saw in the second quarter was a bit surprising to me, and most earnings measures.
Why so?
Well, it showed, I think, pretty incredible management of the later stages of the downturn, where labor input declines were actually still really rapid, yet firms were able to raise margins even with utilization measures, factory activity down. They were able to really shift that to the labor force from their own output and profits. But the good news in that is that their incentive to cut employment and investment very rapidly disappears when their margins improve.
Well, I got to ask you, if firms are still in a bare bones mode, if they're cutting spending and laying off workers, where's the turnaround?
Well, it's happening. It's output. We are literally not making as much as we are consuming right now, even with consumption down. Imports and domestic production is catching up with the sales pace, even though that sales pace is down. So that output rebound is there. I think we have to be a little bit careful, though, about some of the speed of that recovery, which you saw on the ISM data. The orders index had the largest rise in 8 months and 61 years of data through August. It's still growing, but not as quite as fast as we saw in a couple of those reports.
Well, the unemployment rate's nearing 10%. Do you see anything on the horizon that's going to jumpstart that?
Well, I think that all we can look for in the meantime is a smaller pace of job losses. September interrupted that trend, but I think it'll be back in October and beyond. But like the last two cycles, evidence is increasingly suggesting that output's going to have to rebound for a while before you set net increases in employment.
Let's wrap up talking about housing. As you know, there's still foreclosures, people still underwater. Some people, even some prime customers, are just leaving their homes. They're walking out, leaving the keys on the table, and they're heading for the hills. Is this going to turn around at all anytime soon?
Well, I think that fact, the fact that, there's an existing set of homeowners that is underwater, that if they transact, if they have a sale, they'll lock in wealth losses, that's going to be around for a while.
Right.
I think that there are other elements of the housing market, and this is not exactly a pretty picture, but distressed sales are rebounding. We're clearing inventory. The production rates on the new housing side are so low that we've managed to cut inventories more than half in 2 years. So, it's the end of a very ugly housing cycle, and things are still mixed.
Stephen Wieting, Managing Director of Economics and Market Analysis at Citi, joining us this afternoon. Thanks.
Thank you.